Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and another video in our 2021 investing series covering all the best stocks to buy for those higher returns next year. And Nation, today we're covering 5 stocks from a sector of the economy that could be the turnaround story of the year. Stocks in the industrial sector, so think machinery, construction, anything made in a factory, have been some of the worst performing over the last 12 months. The sector is up just 6.3%, the 6th worst return among the 11 sectors and well under that 10% return on the broader market. But the economic rebound has turned this sector into a classic recovery story, gaining nearly 14% in the last 3 months, and we could have a lot further to go on these stocks. Not only is this a great rebound story for 2021 as the economy recovers and these industrial stocks head higher, but these are some great dividend stocks as well and will put cash in your pocket while you wait for those returns. In this video, I'll show you why industrial stocks did so badly this year, but why they could rebound further in 2021. I'll share how I picked the best stocks in the group and then reveal those 5 stocks to buy right now. Don't forget to follow our 2021 Bowtie Nation portfolio on StockCard. We're just a few weeks into the portfolio and already beating the market by more than 18% with a 22% return overall. It's free to follow the portfolio and you'll get notifications whenever I buy or sell from the list, even before these videos come out. Also, don't forget to use that promo code BowtieNation, all one word and all lowercase, for an exclusive discount beyond the free trial. Now, I want to get to those 5 stocks to watch, but I just want to do a quick rundown of the industrial sector and why I think this can be one of the best performers next year. I'm also going to show you how I picked these 5 stocks so you can do this with your own portfolio. The industrial sector is highly cyclical, which just means it follows the economy very closely. When the economy closes down, like it did earlier this year, those big buyers of machinery, tools, and parts, they close down too. Nobody's going to need that skid loader if the construction project has been postponed. Now, new orders for manufacturing weren't that great in 2019 to begin with, and then just plunged in March and April of this year. But that cyclical nature means that when that bounce does happen, it's like a rubber band ready to snap back. Looking deeper into these stocks within this sector, I'm going to be looking for a specific catalyst for each company in this new year. What specifically, beyond that, just that bigger picture rebound can take this one particular stock higher. I'm also going to be looking for a healthy balance sheet, something I'm looking closely at for all my stocks right now. Nation, this year has been a debt bonanza as companies borrow more than $1.4 trillion in just the first 6 months alone, almost as much as a full year of borrowing in prior years. And Nation, the bill always comes due. Over the next few years, it is going to be increasingly important that you follow the balance sheet on your stocks. Make sure they have enough cash to cover those short-term expenses. Make sure the company is earning enough to cover that interest expense and that it's paying down that debt. Now, beyond these 2 factors, I also tried pulling stocks from different industries within the sector for a little diversification in the theme. Our first pick here is KBR Inc., an engineering and construction company in several segments with a 1.4% dividend yield. And while KBR is in 6 different segments, including systems engineering, logistics, and tech, it's 2 here that I think are really going to drive that growth in the future. The defense modernization segment is growing at a 10% annual pace and has a project backlog of $2.1 billion. And the space and mission solutions segment is growing revenue by 13% a year and has a $2.3 billion backlog. In all, the company has booked almost $16 billion in back orders. That's more than 2.5 years worth of sales, so the revenue picture for this one is excellent. Now, through acquisitions, KBR has been positioning itself for greater emphasis on government solutions. And while that acquisition strategy usually just plagues a company with debt, leverage is at the low end of management's target. The company reports $949 million in balance sheet cash. And remember, that's on a fairly small $4 billion company. So almost a quarter of the market cap on this company is in cash. Compare that against about $1.5 billion in long-term debt, and I would expect healthy annual increases to the dividend and more acquisitions to come. The space race and that higher government spending are really going to be the catalyst here, not just in the near term, but further out for a good long-term buy and hold stock. Trading for a price of 16.8 times on that trailing PE basis and a history of growing its earnings, I think KBR gets back to that $32 peak this year and keeps going from there. Shares of FedEx, ticker FDX, are up 80% this year, but have 2 catalysts to really take them higher. Now, FedEx is the world's largest global express shipping company, and the demand picture is just amazing here. I mean, most companies have to figure out a way to create that demand for their product before they can expand operations. But for FedEx, the demand is booming already. Those e-commerce online sales spiked 37% in the third quarter and hit 16% of total retail sales this year from just 12% previously. That trend to shopping online and the demand for shipping has been boosting sales for FedEx for years, but it just gave it supercharged growth this year, and the momentum is just going to keep going. Now, were it only for that e-commerce shipping trend, I might say the shares are a little expensive here, but we've also got another catalyst that isn't fully baked into the shares yet. With the COVID vaccines coming out soon, we could very well be moving into the biggest distribution problem in modern history. Not only do we need to get these vaccines to 7.8 billion people, and FedEx is already ramping up for that, but the two earliest vaccine candidates from Pfizer and Moderna need to be kept at very cold and very specific temperatures. And the problem is this. For example, Pfizer is distributing its vaccine in special deep freeze boxes of 1,000 doses each. Now, those doses have to be kept at a very specific temperature and used within a certain time frame after opening each box. But you've got a lot of towns that won't be able to distribute all 1,000 of those doses. They just don't need that kind of demand. So to avoid the waste and a vaccine that's going to be in short supply anyway, I think you see local governments and states using a lot of that express delivery to move these boxes around where they need them. And the company beat its third quarter earnings estimates by 81%, and earnings for the full next year are expected to jump 37% to $15.51 per share. Between that long-term trend in e-commerce and just the year-long boost from the vaccine, I think this share price can go a lot higher. Caterpillar, ticker CAT, is an iconic manufacturer of heavy equipment in mining, transportation, and construction with a 2.3% dividend yield. Like a lot of these industrial names, the last couple of quarters have been brutal on CAT, with a 23% slide in third quarter sales, but one of the bright spots here is that the company has been rationalizing some of that with cost cuts. So when those sales do return, and they should over the next year, earnings growth could just jump from there. Now, infrastructure spending, that's the only bipartisan issue right now on Capitol Hill, and I know we've been trying to get a deal for years, but there is good reason to believe we could see something in 2021. Beyond that potential catalyst, though, materials prices and the mining companies had a very good year, which should mean strong orders for that heavy machinery over at least the next year. Caterpillar has over $9.3 billion in balance sheet cash, which is enough to pay for a full year's operating expenses and still have money left over, so no liquidity problems here. The $26 billion in long-term debt hasn't increased over the last few quarters, so CAT isn't one of these companies just putting on a mountain of debt just to survive. And here, one of the new features I really like on StockCard is it's going to show you what kind of a portfolio each stock fits with best. Between buy and hold, dividends, and speculation, Caterpillar is a classic dividend stock with 27 years of dividend increases, and we can see here the growth rate over the 1, 3, and 5-year periods with a 15% dividend increase just last year. General Dynamics, ticker GD, is one of the largest defense contractors in the world and offers a 2.8% dividend yield. Now, about a quarter of the company's revenue is from its Gulfstream business jet segment, so that took a hit this year, but the defense side benefits from those ultra-long contract cycles, so revenue drips in here over decades. Case in point, the company reports more than $81.5 billion in backlog orders, with $41 billion in the marine systems alone. I mean, this company is building nuclear submarines, so yeah, that's not a revenue stream that's going to go away anytime soon. The backlog will help support the shares over the next year, and management expects its business jet demand to improve towards 2022. Now, with the profitability gains the company has made over this past year, increasing the operating margin by 2.5% in the third quarter alone, that recovery in sales could lead to an even stronger rebound in earnings. The average analyst target here is for $183 per share, which would give this one a 20% upside beyond that dividend yield. $43 billion Roper Technologies, ticker ROP, is an odd one here, but you can't argue with this success. The company's business model is that it acquires software companies in applications, network, measurement, and in the industrial process technologies. It buys these companies just as they're ramping up their cash flow, and then basically just holds them in a portfolio. That cash flow from those prior purchases is then used to acquire more companies, and the cycle just repeats itself over and over again. Third quarter earnings were impressive, especially given the weakness in this industrial sector, but Roper was able to grow revenue by 1% annually and largely maintained its profitability measures. This business model works really well, and Roper's cost of capital is so low, I think it can pick up a lot of discounted acquisitions this year and next. The company was able to raise $2.7 billion in debt last quarter at a rate of just 1.3%, which is even under the rate of inflation. Now, as a result of this cheap funding and that acquisition strategy, it's been able to grow free cash flow by 13% over the last year and produce a 618% return over the last decade. Check out all the stocks in our 2021 playlist by clicking on the video to the right. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.